This is the Host Planet Mortgage Podcast. Our goal is to share everything you need to know about holiday let mortgages. In today's show, we'll be discussing when owners need to remortgage a holiday let property with Joe Stallard from House and Holiday Home Mortgages. And if you need any mortgage support, to get in touch with the team at Triple H Mortgages today, call 01453 887179 or email hello@hhhmortgages.com. You can also visit the website for further details, hhhmortgages.com/host-planet. Joe, welcome back to the Host Planet Mortgage Podcast. Today we're going to discuss when owners will need to remortgage a holiday let property. So let's start with something that's a bit frightening when you've gone on to the standard variable rate.
Yeah, this is an interesting one, James. I think there might be people out there who realise that this hasn't happened to them. So typically what will happen is you will take a mortgage product that will have an incentive rate for a period of time. Typically, a 2-year fixed rate, 2-year discount rate, 5-year fixed rate. And then if you do nothing after those 2 or 5 years, you will automatically go on to what's called the lender's standard variable rate at that time. Now, that is typically probably a couple of percentage points more than you need to be paying. And if it has happened, it might be worth having a conversation about looking at what else is out there, because there could be some really quick wins to help you get onto a lower rate and control those mortgage payments. And it's one that I think, most people are on top of their mortgages, but equally it's very easy for, if you're not au fait with mortgages, or if it's just the administration's just passed you by, you could be on that standard variable rate. So there could be a real quick opportunity there to look at your mortgage and see if there's something better for you.
Yeah, generally you would notice, because usually your lender will get in touch with you at least about 6 months before, maybe to offer you a new rate generally. And if you do go onto the SVR, if you look at your bank statements, you're probably going to notice that it's costing you more, and you might think, oh gosh, what's happened to my mortgage? So there are signs there, right?
For sure, yeah, absolutely. And, like you say, most people will notice, but you'll probably be surprised at the amount of people that come to us having slipped onto standard variable rate. Either they've got that notification and they've just not done anything with it, or, they might have moved address. So the correspondence, they didn't change that with their lender, so they've missed the notification. And then actually it's a couple of months before they notice the increased payment on, coming out the bank statement. So staying on top of it and checking it out can be a real quick win.
And if you are on the SVR, switching to a new product tends to be fairly simple, because you don't have any early repayment charges, because you're outside of that initial rate period, right?
Correct. Yeah, you've kind of got two options there. There's either an opportunity to have a look at the whole of the market and see where the best deal for you is and go to potentially a new lender. That is called a remortgage in our world. Simple to do, because you're moving the money from one lender to another. There will be a legal element involved. There will be an application to the new lender. Not as onerous as when you bought the property, but still some work to do. Or there's the quicker win, which is taking a new product with your existing lender. And as long as you've serviced that mortgage effectively throughout the life of it, the chances are they're going to offer you a new deal, a new 2-year fixed rate or whatever it might be. So they can tend to be put in place quicker with less questions. I guess, the downside is there might be something better elsewhere. So then you've got to weigh up the time and hassle versus overall cost.
It's always good to check, right? What I've noticed that my last couple of remortgages is that the best deal has actually been sticking with my current lender. So that's what I've done. But I have looked at the whole of market and there hasn't been anything better. That said, it's not always going to be optimum to stay with your current lender.
Exactly, and the circumstances might have changed. You might have done some work to that property and increased the value, and suddenly you're in a different loan to value banding, which opens up a whole world of products you might not have had before. Or equally, lenders, they take on business in cycles. Sometimes they want to be really punchy with their holiday let rates for this period, but then if they fill their book of lending, they've got to go and lend more on residential rates, for example. So their holiday let rates will creep up, their residential rates will come down, and actually you'll find there's a benefit to going and taking a product with a new lender. So, having a look at the whole scenario, rest of the market, existing lender, then you can make the most informed decision.
Okay, then. So the next one to consider, if you are a little bit more organised and you know the end of your rate period is coming up, when should you start looking at what's out there?
Yeah, so this is, we get in touch with our customers about 6 months ahead of their rates ending. So most mortgage offers will come with a 6-month validity period. So we can start to look and secure something from about 6 months out. Most product transfer, so most existing lender rates will become available from about 3 months. So it's that sort of 3 to 6 month period we want to start working on it. If we're concerned about rates rising and we think that they're going in the wrong direction, then jumping on it from 6 months out and securing something is really the way to go, because we're not necessarily committed to taking that product out until you end up completing on it 6 months later. So if that lender's rates do improve during those 6 months, we can move rates down and make sure we get the benefit, but we then also protect against potential rate rises, because once you've got your offer secured, that's kind of your offer. So that 3 to 6 month window, we'll always suggest starting it about 6 months out, but at least 3.
I think that's a really great point, isn't it? Because if you find a really good rate, you can lock it in. So even if interest rates start going up, you've still got that rate locked in for when your mortgage period ends.
Exactly that. And, we need to be a little bit careful there. We need to see what fees come with the product. For example, if there's a product fee and an application fee, and suddenly we're going to be hopping around lenders, we don't want to be wasting client money. But if we're pretty confident with the lender, we know that they're going to be there or thereabouts in terms of having the best rates for that particular client, then securing it 6 months and protecting against those rate rises can really pay dividends.
Now, the next one on the list is better rate. And I imagine this is somebody, maybe they're on a fixed rate deal, but it's not particularly good, and there's a better option available. And even with early repayment charges and the like, it's better to switch.
Yeah, so this is probably a little less common, but there might be scenarios whereby properties have been purchased using a really high interest rate. Perhaps there was something to do with the property that meant that had to be the case, or the purchase type at the time. And actually rates have fallen to a point whereby actually when you do the sums, it's worth paying an early repayment charge and getting out of your existing mortgage and getting onto a better rate. We probably see very few of that in the current market, but equally, there are some shocking rates out there. So technically sometimes it can add up.
Yeah, usually, you can look at the early repayment charges and everything else. And if it's maybe, 0.2 or 0.3 or 0.5% lower, once you've done your sums, it doesn't really make much sense to switch. And that's why I guess early repayment charges exist, don't they, to keep people locked in on those rates. Next one, which might be a little bit more common, is a post-refurb.
Yeah, exactly. So if we think about a refurb, most holiday let lenders are actually, when you're buying a property, they're wanting the property to be in pretty good condition. However, there are some that if we can show you've got the means to refurbish that property over a few months, and we're not relying on the rental income because it's not going to be rented out to do so, then they will do it. Or equally, we might have brought the property using some stage payment finance or a bridging loan or something like that. We love the property, we love the area, we just need to get it up to speed to rent it out. Well, actually, by doing that refurb, we're probably hopefully increasing the value of the property. And I mentioned it earlier, but you may then find that your rate creeps down, into your loan to value creeps down, and you get a better rate because of the amendments there. So, having one eye on the refurb and doing it so that it's nice and attractive to guests and is going to get that property, filled and let out as much as possible is one element. But the other element is, what are we doing to the value, and what knock-on implications does that have to our potential mortgage rates?
Makes sense. Okay, then. Next one, explain this for us, a change of rate type.
Sure. So top level, we've got fixed rates where your rate is set for the product period. Let's use 2 years, for example, in this circumstance. And no matter what happens in the market or the economy, your rate is your rate for 2 years. And as a result, your monthly payment is going to be the same for that period. Variable rate products, either tracker rates, which don't so much exist in the holiday let space, but discounted rates are products that can vary during the life. So they would last for, let's say, 2 years again, but they would follow something like the bank or the lender's standard variable rate and have a discount off that. So this is for typically taken out in times where people believe that interest rates might be falling, and therefore want to get the benefit of those falls as the Bank of England moves its base rate down or as lenders move their standard variable rates down. So that's, in a nutshell, fixed versus variable. Now, what we might have is a scenario where somebody has been on a variable rate, believes they've taken all the advantage of rates moving down and therefore have got it as low as possible, and then now want to switch their rate type and fix it in and actually get off that variability and onto the certainty of a fixed payment. Equally, somebody might come out of a fixed payment and think that rates are going to drop. So actually then we're going to take advantage of that and go for the variable rate option. Very hard, nobody has that crystal ball and we would never advise by promising that rates are going to do something during a period, but equally some people have strong opinions on this and some people are, work in these markets and are educated and want to put this style of investment into their borrowing.
Yeah, it's usually I found that the variable rates tend to be a little bit more attractive than the fixed rates, or they have been in the last few years. The only issue is when you take a variable rate out and then Liz Truss has a budget, that can cause a problem, as it did for me. So I had successive months of mortgage payments going up and up. So beware that. Next one then, Joe, on the list, change of usage.
Yeah, so this is obviously we're talking about holiday lets and short-term rentals here, but actually you might buy the property on that basis and then decide throughout the life of it that that's not what you want to do with it anymore. So, in the terms and conditions of the mortgage is going to be how you have to rent the property out. So if suddenly we want to put a longer-term tenant in there, that means we're going to need to change product and look to remortgage at that period to a proper buy-to-let mortgage. There aren't really many mortgages that cross over the space because the affordability models are different. The lenders tend to be different. There's only one or two products I'm aware out there that will let you short let the property and buy to let the property, kind of designed, I guess, to put a tenant in there over the winter and then take advantage of the shorter term letting over a summer period. That's not very common. So if we want to change how we're using the property, be that put a long-term tenant in there, or actually, we've bought the property with an eye that one day we're going to move into it, we're going to sell up and that's going to become our home. Then when we do that, we're going to need to put a residential mortgage on there. So just being really on top of the terms and conditions of what we're doing and making sure we're not in breach of any lenders and how we should be using that property.
Yeah, it's really important. I've spoken to a few people in recent months and they will have residential mortgages and they're saying, I want to go traveling and I want to rent my property out and I want to do it, short-term rental wise. And the first thing I say to them is, well, have you told your lender? Because you have to tell them, is it allowable? And if it's a flat, is it in your lease conditions and all this kind of thing? So especially with mortgages, and a lot of people, I've known a few people who have bought residential properties, they've lived in them a bit and then thought, right, I want to let them out. So technically you really do need to let your lender know, because if something bad happens and they get wind of it, it might not end particularly well. If you are in breach of your mortgage terms and conditions, what can the penalties be?
The most extreme end of it, James, is it's considered mortgage fraud. So the lender can immediately ask for their money back like tomorrow. They can ruin your credit file. It's not a situation you want to be in. So that's why, whenever you're looking to arrange a mortgage or whenever you're speaking to a broker to arrange a mortgage, being really clear on how you're going to use that property and what you want to do with it is absolutely vital. this sector's got a lot more, thanks to, podcasts like this one, education has really grown in it in the last few years. I'd say when we, just before COVID, sort of 2018 to 2020, 21, the main starting point for a conversation would be is I've tried to do a buy to let, or another broker suggested I do a buy to let. I don't think that's right. How do I get a holiday let mortgage? So, it's still very common. And, just because you're renting the property out, that's not enough detail. We need to know how you're renting that property out.
So we've covered the change of usage then. We've mentioned buy-to-let and residential, changing the ownership style.
Yeah, so we're seeing an increase, I guess, in people wanting to take holiday let mortgages through a limited company structure or something like that. Historically, there hadn't necessarily been the need. I'm not qualified or allowed to talk about tax or that side of things, but I'm sure you've got plenty of information to share with people on that. But it might be that the property has been bought through a personal name, and now further down the line, there's the want to switch it into the limited company structure. There are ways and means about going about that. But again, we'll need to make sure that the appropriate finance is on there, because not so many lenders in the holiday let space do limited company products as of yet, because there hasn't been that historical need, I guess.
Yeah, it's obviously a hot topic with tax changes and capital allowances and all that kind of thing. I mean, usually if you want to switch from personal name to limited company, it's pretty tricky and it's quite expensive. So I think often the advice veers towards, if you're purchasing, then set up a limited company first and then purchase in a limited company. But switching between the two is tricky. But again, speak to the experts on that. Next one then, criteria reasons.
Yeah, so through the life of owning the property, there might be a particular element of criteria that becomes more important when you're considering your remortgage. So a couple that come to mind, suddenly you might be expecting to be coming into some money further down the line. So actually something like a larger overpayment allowance on your mortgage product might be of interest for your next remortgage. So, the typical allowance is 10% of the loan amount each year. There are a few lenders that will go above that, all the way up to about 50% in the right circumstances. So, it might be that product is initially higher priced, but if in 8 months' time you're going to pay off half your mortgage, that's going to offer you a benefit for doing so. Alternatively, you might want something like a particular feature that one lender has, whereby they will waive early repayment charges if you sell the property. So you might go into it and thinking, is this investment going to work? Yes or no? Don't know. I want a bit of flexibility. Okay, right. We'll go with that. It's not the best rate, but if I need to sell this property and bail out, I've got something that's not going to cost me, 4 figures to get out of. So there are many little quirky features and pieces of criteria that different lenders have. So through kind of detailed conversations and fact finding with our clients, we can try and work out what's important. And it's not always the best rate. Rate and cost is very important, obviously, but actually there might be something in there that's going to give you way more benefit than a 0.5% or whatever it is better off.
Yeah, there's a lot more to it than just the headline rate. Finally then, Joe, I'm sure this will interest a lot of people, raising capital.
Yeah, so, if there's equity in the property that you want to utilise to, go and purchase another property, or maybe take out and gift to family, or do some home improvements or some improvements to that property, remortgaging and raising some capital at that point is often something that people do. So generally, there needs to be at least 20 to 25% equity in the property as a starting point. So we'd want more beyond that to be able to pull some money out. But that remortgage is often the easiest point for people to do so, rather than looking at further advances or second charges, which then bring in multiple product rates, multiple end dates, increased kind of mortgage management, if it were. If we can keep it simple and keep all of your borrowing on one product, remortgaging is a great time to look at that.
Yeah, and one way of keeping it simple as well is to, if you remortgage, take that money out, the lender wants to know that you're going to be able to afford the extra loan. So I did this before, and it was very simple. It was like, well, I'm using this extra money to buy another property. So the rental income from this property will cover the loan. Very simple. But are there scenarios as well where, like you said there, you might want to give some money to family, for example, other lenders that will say, okay, we'll allow you to take out, let's say, 50 grand and give it to family. They'll just want to see how it's going to be repaid.
Yeah, exactly. So typically they're still looking at their security and the affordability models on that. So making sure that the rental numbers that you're expecting or achieving are going to cover the borrowing you've got already and the additional. So if that stacks up and if they're happy with what you're going to be doing with the money, then that will be okay.
Fantastic. Okay then, Joe. So if people have got questions or they need some advice, they need to remortgage, they need a holiday let loan, tell us a bit more about Triple H Mortgages and where people should go.
Yeah, so Triple H stands for House and Holiday Home. We're a family-run mortgage brokerage, completely remotely based. We've helped people all across the UK. Visit us at hhhmortgages.com or email us at hello@hhhmortgages.com, and we'll be very happy to chat through your scenario and see what's doable.
Fantastic. We'll put all these details and links in the show notes. Joe, it's been a pleasure as ever. Thanks for joining us on the Host Planet Mortgage podcast.
Great stuff. Thanks, James.
All right, that's it for today's Host Planet Mortgage podcast. My thanks to Joe for giving us the lowdown on remortgaging. To get in touch with Joe and the team at Triple H Mortgages, call 01453 887179 or email hello@hhhmortgages.com. You can also visit the website for further details, hhhmortgages.com/host-planet. Until next time, happy hosting.